Welcome to TheoTrade. This is Don Kaufman. Here we are. It's April 3rd, 2017. Well, if you're turning on the screen right now or towards the end of this trading day, you're probably thinking, well, it was a rather docile trading day, right? Because here we are with about 8 minutes to go to the close. You're seeing the S&Ps down about 5-6 points. What you failed to see earlier in the day was one of the most serious displays of risk that we've actually seen, okay, now in years. Now, again, that's a fairly bold statement. What am I saying, a serious display of risk? Where do you see a serious display of risk? The S&Ps ultimately sold off today. Okay, at one point, they were down just about 20 points on the trading day, hitting a low, and you can see directly on the screen over here, a low of 2340. Before ultimately bouncing back to the upside. Now, the line on your screen happens to be the same line we've been talking about for weeks, all right? It's a huge level in the S&Ps, 2349 on the button. It wouldn't surprise me that if the after hours today, probably when you guys are tuning into this video, that we actually cruised right back into the 2349 level. But let's get back to why such a serious display of risk and what that might mean for markets moving forward. First of all, where's the display of risk? The S&P down 20. Okay, that's just one portion of it. The S&P's down 20 is neither here nor there. Okay, back on March 21st, we actually saw the S&Ps decline 30 handles on the day. That wasn't it. Okay, I got to bring the Russell into scope. The Russell, absolute hammered in early trading today from a level of 1390 trading all the way down to 1364. All right, a little bit of a display of risk. But what really grabbed my attention and the attention of a lot of traders out there happened to be none other than the volatility futures. We'll come to bonds in just a moment. The volatility futures, though, out of the gate this morning, took off and exploded to the upside on a percentage basis, a fairly fierce move from the 1320 level all the way up to 1405 before kind of fading. But that wasn't it. It wasn't just volatility futures exploding. We actually saw the volatility futures, okay, the skew itself flipped over. It inverted. And the last time that we've actually seen any sustained vol skew that again flipped over there happened to be back in January and February of 2016 during a fairly substantial decline. And what I'm really referencing is something I was barking up this tree over the weekend in doing my weekend update. There's something that's been really peculiar in these volatility futures. All you want to view is April. Okay, then you want to view the standardized May. All these other contracts, these weekly contracts, exclude them. And here we actually have APE, okay, at 1333. And the May is going to close right around 1363. So this is about a 30-cent differential. Well, normally this thing should be sitting right around $1, even $1.20. But earlier in the trading session, this 1333, if you look very carefully, these apes actually had a high of 1405. Okay, the apes had a high of 1405. The Mays only had a high of 1390. The volatility futures actually flipped over. This is the differential between a very normal thing, what we call like the contango, and they flipped over into full-blown backwardation. And backwardation is when short duration volatility futures exceed longer duration volatility futures. The only way you can read this, okay, is a display, okay, of markets almost like testing risk parameters. So the way, I would take, and the big takeaway for today's trading session, markets are clearly testing volatility limits and testing lower. In addition to the volatility futures, you've actually got the bonds. Okay, I talked ad nauseum lately about the 152 level at the bonds. It is the most pinnacle level the bonds could be at over here. And again, I'm going to contract adjust this so you can get a better view. I go to futures, go to adjust for contract changes, hit apply, hit OK. These bonds breaking above the 152 level, okay, could have dire effects to the S&Ps. And it, again, on every level, the bonds are confirming, a bit of a breakout to the upside. They're not quite there. They're at that kind of pinnacle level. The volatility futures show that risk becomes imminent. all right? Even where they're closing today, like make no two ways about it. These volatility futures, all right, this ape versus the May contract, they're way too close. 30, 35 cents, that is still screaming risk is imminent, okay? The bonds are at this, this huge level over here. What else do you want to see? All right, let's cruise towards the bottom of the screen. The bottom of the screen, you actually got the VVIX even involved today. This is the volatility of the volatility index. The VVIX was all lit up early in the trading session. The skew is heavy out there. There are a number of very key areas that we look at, okay, for risk parameters. All of them right now are showing displays of just that. They're showing displays of risk. The only way that you can kind of in summation over here is markets, again, in my opinion, are testing lower and really driving volatility. Now, here is something that is also quite shocking for the rest of the week. If you go take a look at the SPX, specifically the SPX options, you look at the rest of the week, it's like nothing at all happened today. And what I'm actually referencing by nothing, look at the 2-day options inside of the SPX. These are the Wednesday, it's the Wednesday expiration. They're trading, okay, on what? A $13 expected move. Do you realize that just the range that we saw today, okay, is 20 bucks? What are they trading for a $13 expected move? These options, okay, it's just a buy. And when I say an option is a buy over there, again, you're like, but are we going up? Are we going down? Doesn't matter. Buy them. I wouldn't sell these options for nothing. You get a 20-point move on a trading session, and you see that, what, all of Tuesday and all of Wednesday? What do we have in here? A $13 expected move? Something's not right. Okay, then you look out for the full rest of the week. The Friday expiration is only a $20 expected move. There's no way in heck I'm selling a $20 expected move when I just saw a $20 move happen today, and the volatility future is still poised for a rip to the upside. At this point, I think it's too early to start screaming duck and cover. But without unequivocation, the markets right now are throwing off every sign of more extreme volatility. Okay, are you going to bite? I mean, listen, the exit is pretty much stage left. It's if you are long markets right now, you might want to heed some of the warning that the markets are ultimately throwing off. Make no two ways about this. Making a down move, okay, after what, umpteen months of an up move is not going to be any easy feat whatsoever. But now, again, we have some very clear and very decisive displays of risk. Consider it in just the days to come over here as we watch these bonds start to rally up. There's the closing bell to very pivotal levels. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.